You save for your down payment, but what about closing costs? Most buyers are shocked at how much money they actually have to bring to the closing table. Today, we're breaking down exactly what closing costs are, what they cover, and how to prepare for them so there are no surprises when it comes time for closing. What's going on, everybody? Welcome back to another episode of Closing the Deal. I am one of your hosts, Sam Enright, and sitting across from me is my co-host, Zach Dickson. Zach, what's going on, man? How are you doing today? Wow, little word salad there.
I like it. Oh, I'm doing fantastic. Cannot complain at all. Another beautiful day. It's officially fall here in Ohio. Cold as cold gets in the morning time. So yeah, can't complain.
That's a thick statement to make. Cold as cold gets.
Already.
Oh, it can get colder for sure. When you're walking out in minus 20 wind chill, you take 40 degrees for sure.
It will definitely get colder. So we'll take
100%.
it as we get it. But yeah, super excited for today's episode. As we teased on the cold open there today, you're talking about a little bit about closing costs as a whole, and I think it is a good conversation, especially for first-time home buyers. Like you said, most buyers are definitely shocked based on when they get that final number and how much they have to bring to the table, and so that's always a fun conversation to have for you, specifically for the lender, but also when they come, have the conversation with me as the agent too. So definitely going to be a good episode, and super excited for this one and to break it down a little bit further today.
Yeah, this will be a good episode for a lot of people out there. I actually just had a conversation with a client yesterday in regards to closing costs and just the overall lack of general understanding from most first-time home buyers as to what that means. Everybody has heard the term down payment. A lot of people just assume down payment means that's all you're going to have to bring to closing. And so, obviously there's ins and outs to it and lots of, it's not just as simple as down payment, right? So it's definitely going to be a good topic for everybody to hear and something to plan for and something to look into, when you do start that home buying process for yourself and, start to prepare for the money.
For sure. So today we're going to really just break down what they are, what closing costs are, what they include, how much to expect, and how we can lower them. So getting started with our first segment, why don't you take us into what closing costs are as a whole, Sam?
Yeah, so closing costs are going to be all of the closing fees that are needed in order to finalize your loan. So, typically what we'll tell people is that you're going to be looking at somewhere around 2 to 5% of the purchase price in order, to cover all of your closing costs. Everything is a little bit different. It largely depends on, what your purchase price is, what your loan size is, those sort of things. I mean, what we'll notice is obviously, those percentages could change. So if you buy a $200,000 house or you buy a $600,000 house, and like 3%, obviously 3% at 600,000 is a lot of money. So what you'll typically find is once you reach kind of a certain plateau, purchase price wise, even the higher you go, like closing costs are really, for the most part, not going to change a whole bunch, right? Because when you look at it, and I mean, we can kind of get into the weeds of breaking down the cost, but ultimately, right, for a lender such as ourselves, we do not charge a client based on their loan size. We charge a flat fee, and most lenders do charge a flat fee across the board, right? It's a set fee, whether you are borrowing $100,000 or whether you're borrowing $700,000. And so, that's why typically once you reach a certain point, you're not going to see those costs, change a whole bunch. So typically we'll tell people in between 2 to 5%. I mean, when I'm talking with clients about, that sort of thing, I never really operate in percentages when it comes to closing costs. I'll usually just kind of estimate, a certain actual amount. And then, another common thing is, closing costs. When are they paid? What is the situation? Are these upfront? Do you have to pay as you go? Closing costs are actually all paid at closing, hence the name, obviously, closing costs. Kind of two things, right? It's your cost for closing the loan, but it's also when the costs are due. So when I think about closing costs, there is only one typical cost that's going to come out of pocket up front, and that's going to be your appraisal fee. I know we've talked about this in previous episodes, but ourselves as a lender versus other lenders, I'm pretty sure most lenders out there these days, do require an upfront appraisal fee from their clients. That's really the only out of pocket fee, right? Everything else is going to be paid at closing. So, that's kind of your general basis of closing costs, right? You're going to have your fees that it costs to close the loan. It's going to be between a certain percentage, usually somewhere around 2 to 5%. And these are going to be fees that you pay at closing as part of your total cash to close with your down payment.
Yeah, I think you hit the nail on the head there with the definition of closing costs as a whole. It simply put, the costs that go into getting your deal to the finish line and ultimately over the finish line too. As we've talked about in a lot of previous episodes, just on not even just on the lending side, but on the title side and et cetera, other sides as well. There's just a lot of moving parts going on the back end of the contract, of the process to get the deal to the closing table. And obviously those things cost money. We have professionals working on title, professionals working on the lending side. Those are things that are going to cost money. Recording fees with the county, stuff like that is stuff that is going on throughout the process, but ultimately is what is needed to get it to the closing table and get it to, get the deal closed as a whole. So yes, they are. I think there's a little bit of a stereotype out there for buyers that they're just kind of, sunk costs, that they're just throwing money into something that they're not going to get back. But these are, they have to be done. You want to have a clean title on the property. You want to have financing on the property. You have to do all these things to buy the house, and to get to the closing table. So they are most definitely a necessity. And obviously we'll break down in future segments, in the next segments, where they come from and also how we can reduce those to make it a little bit more manageable for you as a first time home buyer in general.
Yeah, for sure. And obviously when we do break down, we'll talk a little bit more in depth, right? Because I know you mentioned just right there, like sunken costs, thinking that you're getting nothing out of it. Well, there's always there's a rhyme and a reason to all of it, right? There's no just throwing money at the wind because, to heck with it, that's what we're going to do. Ultimately, we always like to remind people, like you mentioned, for the title side of things, like you're getting the lender is getting a title insurance policy, making sure there's a clean title, making sure that's backdated to a certain point. That way, if anything pops up, if anything, was missed in the search, that you are not becoming financially obligated for a previous judgment or a previous lien that is on that property that is not yours, right? And so that's what, title insurance is going to protect you of. And then you also have, the title work as well, just as the search, any sort of, different things that they do. And so it's like, obviously most of you work a job, when you go to your job, you show up and you clock in, you expect to be paid for the work that you do, and then you go home and you receive a paycheck for that. And it's the same thing for, us in the lending industry, the title industry, everybody that is going, they're doing the work on this property, obviously what do we do in America? We exchange, obviously our time and our skills for money. And so, if you need clean title, somebody's gonna be able to give that to you, but you're going to pay for that, right? And same thing on the lending side of things. If you want money lent to you, lending teams have underwriters, they have processors, they have the mortgage loan officers themselves, they have everybody on the back end, on the closing team, on the post closing team, like everybody in the company has to get paid for their role in the loan. And so, obviously these fees help go towards those things for the lending company, right? And then some of the other costs are going to cover things for you specifically. Obviously we'll get into that, but just wanted to throw that in there. Cause like you said, a lot of people just look at closing costs and they're just like, oh, I'm just paying all this money. And, what am I really getting out of it? Or why do they need this? And it's like, ultimately, we all have a job to do, right? And we all want it done to the highest level that we can. And so ultimately you're going to pay when it comes to those sort of things, right? Nobody goes to work and expects to walk out working for free.
Couldn't agree more. And like the last thing I'll say on it is really, the cost up front to do these things. completely outweighs the cost of, having to pay a lien that you are not responsible for, or having to pay the entire purchase price in cash because you are not able to secure financing. So all of those things, they help you out ultimately. You may have to pay upfront, but they do help you out in the long run, and protect you as the buyer. So,
Yep, for sure. I couldn't agree more. So guys, kind of getting into the breakdown, right, of what are closing costs. Obviously, Zach and I can kind of go into the, the little nuances here of each one. But, when I look at like a loan estimate sheet, which is a document that you're going to get in your initial disclosure package, it's going to kind of break down your fees, right? Or at least just a baseline of your fees. So section A is going to be origination charges. So in here, you're going to see what what the lending company is charging you in order to do the loan. So you'll see things such as like an application fee. You'll see things such as like an origination fee. And then if you have a client who is, buying a rate down, or you're doing any sort of thing like that, what you'll typically see in this section as well as points. So a point is basically 1% of your loan amount, and it's a charge to get, a portion of your interest rate bought down, or whatever the case may be. So, that's going to kind of take over section 1, right? That's where you're going to see your lender fees. Like I said, most lenders, again, charging a flat rate across the board, either between 2 fees, 1 fee. It doesn't really matter. It's in there listed. And so you're going to be able to see, okay, this is exactly what the lender's charging. Caveat to that, there is in no way can a lender charge you more before closing. So we can't disclose $1,800 to you as lender fees and then say, wow, this loan took a lot more work than we thought it would. We're going to, hike this rate up to $2,500. It's not how it works. Ever since post 2008, the housing market crash, they came in with rules and regulations. And so this initial disclosure is very, very important for lenders, because whatever is disclosed on here, if the fees end up increasing, we have to eat those fees ourselves personally. We cannot go to the borrower and charge them more than what we originally disclosed to them. So you guys are protected there. So whatever those fees are that are listed by the lender, those cannot go up in that section A, section when it comes to the origination, application fee, those sort of charges, right? So something to keep in mind there. When I think about section B, it's going to be services you cannot shop for. So this is going to be things that we need for the loan. So typically what we're going to do is we're going to have an appraisal fee in there. We're going to have a credit report fee in there. You're going to have a flood certification fee in there, electronic closing fee, an inspection fee, just in case we have to send the appraiser back out to the property to review after repairs are done, and a few other just miscellaneous things, right? And so in this section, these are obviously things that we need to get for the loan. There are things that you cannot shop for. We're going to need an appraisal in order to get the loan to the closing table, right? And so we disclose these fees. Again, same rule as above. If we disclose $550 for an appraisal and the appraisal is $600, we have to eat the extra $50. We cannot charge the borrower more than what was disclosed on this initial disclosure. So, we will, in that section specifically, right? So when it comes to the things that we have control over, we cannot charge more. So those are going to be your first 2 sections. Zach, I'll let you touch on, I know you probably don't know the LE necessarily, but, section 3 is services you can shop for, which is going to take you into kind of title fees. So what can people expect to see in that section?
yeah. So every property, when you go into contract, ultimately what's going to happen to get a clean bill of title to pass along to you is we are going to have a title search done. And so just depending on the property, an agent or a title examiner may have to physically go out and examine documents for the title on the property at the county courthouse, or depending on the county, sometimes those documents are available online and able to be seen on there instead of having to drive out to the actual courthouse itself. And so obviously if an examiner is driving out there, that is one cost to do the search. There is a cost to do the search as a whole. Obviously when they do provide that clean bill of title and the insurance on the title, there is a cost associated with that as well. And so ultimately, those are going to be pretty straightforward as a whole. But moving into the kind of next section of the closing costs is going to be your prepaids. Having to ultimately, if you're financing the property, you're going to be setting up escrow accounts more than likely. And those escrow accounts are going to allow you to set money back each month for your property taxes, for your insurance. And so we ultimately, when you get closed, you have to get those escrows started, have to get those funded to begin with based on the day that you close and when that next payment is going to be due, whether that's taxes semi-annually in January and June, or whether that's whenever your semi-annual or annual insurance premium is due. And so just kind of based on the closing date and when those things are due, that is how those numbers to fund the initial escrows will be determined. And then in your monthly payment, obviously you will see a breakdown on how much you are paying into those escrows each month based on your monthly payment. But at closing, you do have to get those funded to begin with, and kind of get started, get up and running. And then the last thing on the prepaid side of things will be your interest. Again, it really just depends on the day of the month you close, on how much interest you are paying. If you are closing on the first of the month, you will not pay a mortgage payment until 2 months from that day. And so your prepaid interest will increase based on that number. Now, if you're closing at the end of the month, your prepaid interest will reduce, but you will have a mortgage payment in about 30 days or so. And so really those numbers are going to be just determined based on your closing date and when those things are due. And then the last kind of cost that goes into the closing costs is really your recording and transfer fees that are set with each specific county. Usually they're pretty standard, a couple $100, nothing too crazy at all. So that's probably going to be one of the lower categories in the closing cost breakdown as a whole.
Yeah, for sure. And then, and obviously we can kind of, there was some things I wanted to talk about inside there, mostly on the prepaid side of things. But I also wanted to mention one other closing cost that we've seen over the last couple of years change, and that is buyer agent commissions. Obviously, due to the rule, the rule that came out, and obviously prior to this, there was really no disclosing. It was just assumed that the seller would cover, all agent fees, buyer and seller at a full 6%. They'd split it 3%, 3%, or, whatever was negotiated ultimately, right? Now, obviously, these things have to be talked about in the contract phase. We've now started, there's a section in the purchase contract that now includes the buyer agent percentage and that sort of thing. So, if that is something that is not being covered by the seller, that is something that will be listed on your LE. So if you have to pay your buyer's agent a full 3% commission, that will be in an other section down in the other loan costs. So just something to think about there, as you go into closing costs, right? Because obviously, if you bought a house in the past and it was a couple of years ago, this was probably not even brought up at all. It was just, ultimately just assumed seller's going to cover, and they likely did, and everybody went about their way. That's not exactly the way that it goes down anymore. So, we don't, again, a lot of times now still in our contracts, in the area that we're in, Fairfield County, that sort of thing, we are still seeing sellers covering either a large majority of it or most of it. I think we just closed a loan last week down in Hocking County, and the seller covered 2.5%, buyer covered the other 0.5% themselves. So, it's still a large majority coming from the seller based on, the contract offer and all that stuff. But, again, just something to be aware of, because that is something that has changed. It never used to be that way. When I first got in the business, it was, yeah, you're never going to pay any, buyer agent fees as a buyer. Like it's just not your responsibility. Right. So, and now, there is obviously a chance that it could be. So, we do have a small example here for you guys, just kind of, give a breakdown, on a $250,000 home, you'd be looking at, most lenders are going to be right around $1,800 to $2,000, right, in lender fees, just depending. It could vary a little bit on each side. Your title company fees, again, going to be in that same realm, right? You're going to be roughly around 1,800 to 2,200. Sometimes I've seen them a little bit higher. Obviously, it just depends on, the size of the home and how much, lender's title insurance you need and that sort of thing. Prepaids, I would say around 2,500. You do have your first year's homeowner's insurance, with which for the most part you're going to be somewhere around like $1,000 to $1,500 there, straight out of pocket at closing. And then your prepaid interest, kind of like Zach talked about, is really going to depend on the time of the month that you close. The earlier that you close in the month, the larger your prepaid interest charge is going to be, because they're collecting from the day that you close until the first day of the next month. So, I mean, if you're collecting a whole 30 days worth of interest, that's going to be a lot more than if you close 10 days prior to closing, or prior to the next first day of the month, you're only going to collect 10 days, right? So, that can largely depend, but I would say on a rough estimate, you're going to be looking about 2,500 there. Escrows, again, just depends on, we always collect 3 months worth of homeowners insurance. That doesn't change. Homeowners insurance is due annually. And so the reason we collect 3 months is because obviously by the time you make your first payment, you're already going to be likely a month out. So we'll have 11 months full of payments. And so by the time you get to the end of your first year, you'd basically have 14 months worth of insurance money in your escrows, when all you need is 12, but it does cover just in case, hey, they decide to raise the premium or something happens, to where, they need a little bit more money, they build in those. And then taxes, all based on the time of the year that you close. The closer that you close to the, I guess the further away that you close from when the bill's due, the less, escrows you're going to collect, right? It makes sense. If your bill's due in February and we close in August, you're going to make a September, October, November, December, January payment before your taxes are due. And so there's going to be plenty of money in that escrow account. And so we're only going to collect, 3 months to get you started. Now, if you're closing in December and your tax bill is due in February and you're only going to make one payment, obviously they're going to collect a lot more in escrows when you get at closing, to make sure that account is properly funded. So, anywhere between, I would say roughly around $1,000 there. And then other fees you're looking at, like I said, the appraisal, that sort of thing. You're looking around $800 there. So you're looking at around total probably $7,900 in total closing costs. However, I do want to add a couple of things in here, because in Ohio, there's a couple of unique items that typically are going to count as credits to you, that are going to bring down your closing costs. So for most clients, we'll typically tell them, hey, closing costs are going to be between $5,000-6,000. Obviously, when we just talked, I just told you that the closing costs in this hypothetical were $8,000. So where's the discrepancy coming from, and where's the, additional funds? So in Ohio, taxes are paid in arrears. So when you owe property taxes, like this year, you're paying 2024 property taxes. If you're a homeowner, right? And so when somebody is selling you a house, and let's say you're buying at the tail end of 2025, all of the 2024 taxes should be caught up. So next February, 2026, what's going to happen is 2025 taxes are going to be due. If you just bought a house in 2025 and did not live there for a majority of the year, you're going to get what's called a tax proration credit from the seller. So basically, from the first day of 2025, January 1st, until the day that you close, you're going to get a tax proration credit for however much time that is. So obviously, the larger the house, the larger the taxes, the bigger the credit. The smaller the house, the lower the taxes, the smaller the credit. We just closed one the other day where the tax credit was like $3,600. We've closed them where they're like $1,400. So it really just depends, right? But again, that's going to count towards your coming away from your bottom line. So, in this hypothetical situation, yes, there's $8,000 worth of closing costs, but if you have a $2,000 worth of tax proration credit, that right there is automatically going to cut those costs down to $6,000, right? And then another thing is in like Fairfield County, Franklin County, Licking County, it's very popular, or it's very common for a seller to pay what's called an owner's title policy credit to you. So there's two different types of title insurance. There's a lender's title insurance, and then there's an owner's title insurance. In most of these counties, I know, like when you start getting out a little bit, like Guernsey, Muskegon, this is not something that goes on their contracts. So, but usually in the like I said, Franklin, Fairfield, Licking, you're gonna have this. It's gonna be basically an additional credit for an owner's title insurance policy. So I've seen those credits anywhere between $800 to like $1,700, just depending. They do charge an owner's title policy credit. Like we have a client right now that's being charged $800 for an owner's title policy credit, but they're getting a $1,700 credit from the seller. So, basically $900 left over is going to go towards bringing those closing costs down even further. And so that's kind of how you end up in the $5,000 to $6,000 range, is based on the tax proration credit as well as an owner's title insurance policy credit. So just something to think about there, because I know that obviously people do get caught up kind of in, what are the closing costs going to be? And that should be a good breakdown of like, here's A to Z. This is everything that you're going to have on there. Obviously, if you have certain properties, they're going to come with, like, a manufactured home has a couple of fees that would not be on a normal stick built house because you have to get additional items. But for the most part, that's going to apply to basically most loans, right?
Great info for sure. Great info. Got us a good example for the viewers, and hopefully that was super clear and concise for them, and will understand and not be super surprised when they get that LE with the closing cost number at the bottom of it. So good example for sure.
We always got to tell people, like, hey, just they'll get the LE and they'll start to be like, oh my gosh. I'm like, listen, 9 times out of 10, whatever's disclosed in the beginning, it's always going to be less than. We have to, again, cover ourselves. We talked about this, right? Like, a lender has a base template that they're always going to put out there, and once the actual fees and invoices start coming in, we obviously adjust those things accordingly to whatever the actual fees are for the loan. But so I always tell people, because they get a little, obviously worked up as soon as they see that first LE, like, hey, let's all slow our roll. We got to get the title company LE or pre-CD, we got to get all these things. So obviously just bear with you. I'm not saying every lender operates that way. Some are, we had a client that was talking to a lender, and their costs were like, they were putting down a down payment of 20,000. Their costs were like, cash close was like 50 grand. And we're like, we don't know where that money would quite possibly be coming from. Unless we see an LE, we don't really know. You know what I'm saying? But, not every lender is the same. We try to pride ourselves on being upfront, honest, because ultimately you're going to see the LE, so you'll know what's going on there. So anything that we try to, quote unquote, anybody who tries to pull a fast one on somebody, there's no way to do it ultimately, right? Because you have to disclose the information to the client, to the borrower. So yeah, would be silly to not tell the truth from the get-go.
No doubt about it. No doubt about it. So I will take us into our next segment here on our episode. It's going to be talking about who pays what. And I think it's pretty self-explanatory to begin with. Obviously you have, as a buyer, you have closing costs that are associated with closing your loan. And so ultimately those costs are going to fall on you as the buyer. Now, yes, the seller does have closing costs of their own. And while we'll get into what can be done, obviously, as for you as a buyer to kind of reduce it, but you as a buyer and the seller both have separate closing costs ultimately to get the deal funded and closed. However, when you are in a situation where you have a little bit of leverage, a little bit of negotiation power as the buyer, there are scenarios where you can ask the seller to pay for some of your closing costs, give seller concessions that allow you to reduce those closing costs. And so I think the number one example that really stands out in my head to begin with is if a property is on the market for a very long time and the seller is really looking to get it sold, looking for a buyer, needing to get it sold in a position to where they need to. That is a scenario where your buyer's agent would be able to negotiate $2,000, $3,000, $4,000 worth of seller concessions that allow you to reduce those closing costs as a buyer. And why they will accept it at that point, or why it may be an acceptable offer at that point, is because they are not in a position of demanding, in a position of leverage. If the property's been on the market for 30, 40, 50 days in a row with no activity or no acceptable offers at that point, ultimately they are looking to have the property sold and they need to get it sold. And so maybe giving up $2,000, $3,000, $4,000 in concessions on the deal to the buyer will allow the deal to get closed and ultimately their bottom line to their pocket. Another example where sellers would give concessions is if, you know, a inspection report came back negative, something came back on the inspection report that the buyer did not agree with. Obviously, the buyer at that point can decide to have the issues fixed, actually physically fixed in lieu of money, but they also can ask for concessions as well to lower the amount of money that you have to bring to the closing table. And so that would kind of work out in a scenario where we have a handyman buyer that wants to kind of do the work himself and would kind of just, you know, want to reduce the overall cash to close. And so I don't think I would, I don't think I have another example where a seller would give concessions, but yeah, it is getting a little bit more popular as a whole here in our market. You know, 3, 4, 5 years ago, if you put into your offer, into your contract to send to the seller with seller concessions, they probably would have laughed at you. I think I've mentioned that in previous episodes as well, but it is definitely becoming more prevalent as more properties sit on the market for a little bit longer of time, and you know, sellers are desperate to get it sold and get it off. So why don't you talk to us a little bit about, you know, lender credits or special programs that can help offset a little bit of the buyer closing costs?
Yeah, I mean, lender credits can definitely help. I mean, it just depends on your lender, right? I mean, there was a time where, I remember there was a time back in 2020, 2021 where, we had the ability to do some crazy lender credits. Like I remember we would, have USDA borrowers, that would have money, and we would, lender credit up to, $1,000, $1,500 to help get them, to zero down. And so, that doesn't necessarily exist really much anymore. Obviously, things have changed. The market as a whole has changed. Just in general, since that 2020, 2021 time, obviously things were extremely booming, low interest rates, crazy, just crazy time ultimately in the mortgage industry. So things were a little bit different, but, yes, can we, do lender credits? Absolutely. If there's, if we're a couple $100 off and we have clients who are, going USDA or using FHA with like a down payment assistance program or something, and have seller concessions and want to, be as close to zero or at $0 as they can, we do have some options that we could, potentially do small lender credits to help get it there. As for like special programs that can reduce like out of pocket costs, I don't know any that are necessarily going to cover seller concessions as a whole. Every lending company is different, right? So like there's a local bank here. I always give this example. There's a local bank here in the area, community bank. In the spring, they will always do like for a month, they'll do like a little special, like we'll do $5,000 grant for your closing costs at, if you come and basically close a loan with us or whatever, come and work with us, in your picked as one of these people. I think it's a first come, first serve basis. I don't really know a whole bunch about it, but I'm just saying, like, they do a special thing where, you can get a $5,000 grant, right? Our company, we don't necessarily do anything like that. We don't have really, it's just not what we do. There are companies out there that do it, but, we do have access to like down payment assistance programs. OFA used to be a popular one when it came to like covering not only, down payment, but also seller concessions. They used to do a 5%. So like if you went FHA, you'd have 3.5% of your down payment covered, and then you'd have 1.5% left over to go towards closing costs. They recently changed everything in July. So, they only do the down payment itself now. But I mean, in that situation, it doesn't really matter which way you slice the cake, right? So if you need, if you have money saved up for a down payment, and you want to go with a down payment assistance so that you can spend the money on your own seller concessions, the money's still coming out of your pocket all the same, right? Instead of having to combine down payment and, closing costs. In this instance, you could have the closing costs or the down payment covered by OFA, and then you could, bring out of pocket the remainder of the closing costs that you need yourself. So, I mean, there's other programs out there. There's another down payment assistance program that we have, really the big one when it comes to closing costs that we see a lot is not really going to be any of those things, it's always going to be seller concessions. We, like you said, Zach, this has become more popular. I mean, honestly, here at Kaysen, the way that I've been in the business for, 6, 7 years now, I mean, obviously I've worked in different areas. And so I'm not as, familiar with Franklin County specifically. And so I know that the market is different up there. I know that you're going to have buyers and sellers that are expecting more and likely not going to bite on those sort of things. But in the areas that we work in, when you're kind of on this outskirts of like Franklin, when we're looking at Fairfield, we're looking at Muskingum, we're looking at Guernsey, we're looking at Perry, seller concessions are very, very common there. And so if you're somebody who truly does not want to pay for your closing costs, one of the things that Zach did not bring up that, we have, what you could do is you could structure your offer in a way where you offer more to the seller and ask them to contribute seller concessions that way, so that ultimately they're not impacting their bottom line and you're getting the benefit, right? As long as the house is worth the value, let's just say easy numbers, you have $100,000 house on the market, you need $5,000 to cover your seller, cover your closing costs. You go to the seller and say, hey, Mr. Seller, I want to offer $105,000 on this house if you give me $5,000 seller concessions. The seller still ends up with their $100,000 that they were anticipating, and now you've gotten yourself in a position where your closing costs are covered. As long as the value of the home is there, if the home's worth 105, 110, then you can tap into that and use that. So, that's another way when you go to structure a contract, when you go to offer on a property, that you could work that in if that's something that you're looking to do. So I mean, that's really kind of the main way that we see, seller or buyer closing costs get covered, right? Seller concessions. But there are other options out there if those are things that kind of intrigue you. Obviously we're always open to talk about those and kind of see what we can do. But every lender is a little bit different, and there are some out there that do have some small grant programs and those sort of things that can kind of help get you through the door, right?
I could not agree more, brother. Could not agree more. And there's scenarios where you can bring legitimately nothing to the table, just depending on how your deal is structured and how much sellers are willing to contribute, and et cetera, et cetera. There's scenarios where people come to the table with $0 down. So moving on to our last segment here on the closing cost front, and it's really just talking about how we would prepare and how we would go about saving. My suggestion is always going to be, obviously, if you are thinking about purchasing a home in the future, start saving as early as possible. That doesn't just include closing costs, but that includes just your down payment and closing costs as a whole. All of those kind of wrapped up into one. Just start saving as early as you possibly can. Utilize some of the saving tools out there, high yield savings account that allow you to have higher interest rates on your savings, money market accounts, things like that are, FDIC insured by the US government, but allow you to, collect a little bit more interest on your savings as a whole over time as well. I don't know if maybe a little known topic, but your typical savings account is only paying probably 0.1% in interest as a whole throughout the entire year, where these high yield savings account, money market accounts are paying 3, 4, 5% annually. So ultimately, yes, get started saving early and find one of the vehicles to actually save. Don't use just a piggy bank in your room or one of those old savings accounts. Definitely a lot better vehicles and ways to do it for sure. And then obviously, like Sam said, you will get a loan estimate early on in the process, and it probably will take you aback. So just make sure you're prepared for that. But ultimately, if you have been saving, for that good amount of time period, it probably won't as well. So make sure you get that early on in the process. Obviously, like Sam mentioned, that will happen from them early on. And so you'll be able to kind of review that and take a look and see where we need to go kind of from there. Obviously, you don't have the full picture in front of you at that point, but, most of it. And so kind of can dictate, where we want to go from there.
Yeah, I mean, even lenders don't have the full picture, right? Because ultimately there's title there's title fees on there, and so this is why I think working with someone that you trust, someone that's reputable and that you trust is so important, because ultimately, right, if you're looking at an LE and I call you and we have a conversation and you feel like I'm lying to you or I'm withholding the truth, you're not going to feel very good about, where things are headed, right? Just like how I gave you the example of the client who said, the lender was telling them 50,000 when their down payment was 20,000. Where was the 30,000 coming from? That's, something that ultimately, that's why they ultimately ended up leaving, right? And they're like, yeah, we don't know. We're not getting the explanation we're looking for why is this $30,000? What is it? You know what I'm saying? And so if you're not working with somebody that you trust, somebody that you feel is reputable, it's going to be very hard to build that trust when I, reach out and say, hey, look, this is what your LE looks like right now, but you got to understand this is just the very, very beginning. You're going to see numbers update. I promise you they're going to update. You got to bear with me. We got to wait to get the title work back. We got to wait to get the pre-CD from them. And that way we can see their actual fees, see what the tax proration credit's going to look like, this, that, and kind of go through that with you and try to obviously bridge that gap of what you're seeing versus what it's going to end up being. Like I said, most of the time, 9 times out of 10, you're going to typically see a loan estimate be higher than what your final closing disclosure is going to reflect at the end of the transaction, right? Unless something's changed, you decided to put more down payment money down or something like that, some unforeseen thing, comes up. You owe your agent 0.5% or something like that, and we didn't know about it in the beginning. That sort of thing can definitely go in there, but yeah, obviously you're going to want to be prepared for that, and I think for me, the largest thing, and we've talked about this several times is expectations, right? I think getting in touch with a real estate agent, getting in touch with a lender, talking about the area that you're looking to buy in and setting the proper expectations is going to be, massive. If you are buying in a heavily, in an area like Franklin County where there's a lot of, competition and you're going after houses that are newly renovated and are on the market and everybody's in love with them, like you got to be realistic that, if you don't have money for your closing costs and you want them to cover it, like that's something that may not happen, right? But if you're going in a less populated area and houses that have been on the market for a little bit longer, and need a little bit of love and elbow grease to get them where they need to be, like you're going to have a little bit more success in maybe getting the seller to contribute some of, if not all, to your, your closing costs, right? And so I think that's the thing. Obviously, save your money, make sure that you're in a position. But I mean, if you have the opportunity to have somebody cover closing costs for you, why would you not take it, right? So you can keep the money in your own pocket. So that's another thing too. So, linking up with good professionals, people that are honest and people that you trust, I think is huge. And then setting the right expectations. I always ask most clients, hey, what area are you looking in? Are you looking to stay in the same area that you're at? Are you looking to move? What are we doing here? And what does that look like? And okay, hey, having that conversation or telling the agent so that they can have that conversation is like, hey, look, this is probably not going to happen for you if you're looking in Fairfield County or Franklin County and you're going after a house that already is, has 30 showings scheduled in the first 2 days. And, we've already got 5 offers and there's, expected another 10 or whatever the case may be. You know what I mean? Like, just something to think about there. So, and then obviously getting started, I think one of the biggest things you could do is, obviously until you have a house, you don't really know. But, start shopping for insurance, early on in the process when you do find a house. This is one of the things that is kind of, it's in the control of you, the buyer, right? Everybody has their own different type of insurance score. You are able to go with whatever insurance company that you want, and this can make a massive difference, right? So if you find a policy that's $2,000 a year premium, obviously, one, your cash to close is going to be higher if we disclose 1,500, and your escrows are going to be higher because you have a higher monthly, insurance amount that's due. Those two things are going to make your closing costs go up. Or on the inverse, if we disclose 1,500 and you found insurance for $1,000 or $1,200, now all of a sudden your cash to close has gone down $500 or $300, and your escrows have gone down too because we're no longer collecting as much money because your monthly amount is different. So I think shopping insurance, we have a lot of clients that come to us. What am I going to bring to closing? What am I going to, we're 2 weeks out from closing. They still haven't gotten us insurance, and they're wanting us to give, accurate figures. It's very, very hard to give accurate figures when we don't have the whole picture, right? And this is why I always say, look, this is going to be fairly more accurate, but until we have this, this, and this, I cannot tell you 100% what it's going to be, especially when it's insurance and it's outside of our control as the lender, right? Because it's something that you get to shop for. And then last thing, negotiate strategically, right? This is, kind of what I said in just a few seconds ago, and just about, if you can get seller concessions, why wouldn't you? Even if you do have the money saved up, would it be better to get the seller concessions? I mean, that's for something for you to weigh out, but that's how I would, kind of go into the prepare section is, I know if I'm working with my agent and we're trying to purchase a home, I'm negotiating seller concessions. That's just me personally, and I will go in with the expectation. Okay, yeah, I might strike out on the first 5, 6, 7 houses that I put a contract offer in. That's fine for me. I'm okay with that personally. And so it's just understanding what these things mean and understanding what is going to ultimately happen from that, right? So that's where it leaves me at. Is those would be kind of the things that I would do to prepare. Obviously, Zach touched on a couple as well.
Well, Sam, I think that is all that we have on the docket today for the closing cost episode. We about 50 minutes or so here. Good.
That's actually, a little surprising to me.
Yeah,
I
good,
did
thorough
not
information
anticipate
here.
that we would spend that long on this topic, but I think that it's a good one, and it's one that ultimately you guys can come back to when you purchase a home, and really really kind of, I mean, I think when we obviously went through the different fees, I mean, we covered basically everything that you can anticipate to see on an LE, right? So obviously a good episode, and very, very important. Very, very important as a whole when you're going to buy a house, to understand what you're getting yourself into, right?
For sure, because I think there's just a lot that lays in the weeds too. A lot that you can't see on the surface, and as we talked about in the very beginning of the episode, first time home buyers see these numbers and they're shocked. So there's just a lot that you can't see on the surface that hopefully we shed some light on today, for sure.
Yeah, absolutely. And it doesn't have to be overly, scary or terrifying. Again, it's all about proceeding with the right expectations, understanding what your goals are, and getting together with a good team that's going to help facilitate those goals, right? So, I mean, just because, we have clients all the time that buy houses that are not prepared for closing costs, right? Like, it's not like, yes, they have some money set back, but they don't want to, they don't want to come out of pocket. It's not that, you have to have, it goes back to the 20% down, right? You don't have to have all of this money saved back to buy a house. It's just, you got to be prepared and understand what is going to come with whatever your specific situation looks like. So, this episode was not put together for you guys to be like, oh my gosh, unless I'm sitting on $7,000 for closing costs specifically, I'm never going to buy a house. You know what I mean? Like, it was just ultimately to bring awareness and understand that these are things that are going to be a part of purchasing a home for you, but also that there are ways to navigate around them if that's what you're looking to do. So, guys, if you're thinking about buying a house, ultimately, guys, if you're thinking about buying a house, feel free to reach out to Zach or myself. We can kind of sit down and have that conversation about what to expect based on, where you're at in the process, what you're, where you're expecting to get to, and those sort of things, and kind of, help you make a game plan, right? So you don't feel like you're alone in this. Again, the whole premise of the episode was not to, make you guys feel like, you just have to go save up all this money in order to buy. It is beneficial. Obviously, the more money you save obviously gives you more options, allows you to be more free in your negotiations. But again, it's not a requirement. It's something that can be negotiated and maneuvered around. So just something to keep in mind there.
Couldn't agree more. Not one size fits all. I don't think one thing in real estate files under the one size fits all policy. So never, just got to take it all with your own personal situation and never really, make any assumptions. So
100%. All right, y'all. Well, appreciate you guys tuning in. Was a great episode. Hopefully you guys took something away from it, and excited to get this one out to you guys. So again, if you have any questions, don't hesitate, reach out to Zach and myself. We'll catch you guys on the next episode.
absolutely, guys. Thanks for tuning in. Cheers.